Okay, class. Now let's start our class. So good afternoon, everyone. Welcome back to financial reporting class. Today we are going to proceed from where we stopped in our last class. Remember that in the last class we looked at analysis and interpretation of financial statements, and we discussed majorly ratio analysis as a tool for analysis and interpretation. Though I told you that there is the statement of cash flows that can be used for analysis. There is the trend analysis that can also be used. But our focus was majorly ratio, which is also going to be the focus for your exams. So in looking at ratios, we mentioned the categories of ratios that we have. We said there are 5 categories of ratios. We looked at the profitability ratios, liquidity ratios, efficiency ratios, solvency, and investors ratios. We looked at several ratios under each categories of ratios. We looked at them one by each. And that was basically what we did last weekend in our second period, I guess. So today now is for us to solve past questions on the formulas we have learned. Let's see how I can ask this part of your syllabus. So the reality is this part of your syllabus is an aspect that is asked every diet. Every diet they ask it. And my plan for you is to solve as many questions as possible, so that if possible, this should be an area that you should run to as your number one question if possible, so that you can maximize question in this area. And that's what we want to look at in our first period today. So let's start with last diet question, which is November 2025. November 2025. Okay, so I know we selected somebody that would read for us last week. I think it was Shidera. I'm not sure if she's in class. If you're in class and you're in a position to read, please read for us.
I'm here, sir. Good afternoon.
Hi, how are you?
I'm fine, thank you. And you?
I'm okay. I didn't get your assignment. You cannot just be reading in class. It comes with a lot of responsibility.
Sorry, I forgot. I'll do that immediately after class.
Okay. All right. Please read this.
Okay. Question 3. Chike Oils Limited is an oil and gas company operating in Nigeria. The management of the company presented the following summarized financial statement for the years ended 31st December 2022 and 2023. Statement of profit or loss and other comprehensive income. All figures are assumed to be correct. And statement of financial position as at December 31st. All figures too are assumed to be correct. Then required. Additional information, Additional information 1. Chike Oils Limited acquired 60% interest in the equity share of Ducal Agro Limited, a commercial cocoa production company, in order to diversify its business portfolio and take advantage of the favorable incentive in agriculture recently announced by the federal government of Nigeria. Additional information 2. Ducal Agro Limited increased its plantation based on average yield per hectare. Additional information 3. No dividend were received from Ducal Agro Limited, and the value of its shares had not increased during the year ended December 31st, 2023. Required, calculate the following ratios for years 2022 and 2023. Gross profit percentage, net profit before interest and tax percentage, and gearing ratio for 9 marks. Then B, comment on relevant qualitative factors that may impact on the company's performance for 6 months. The C part says prepare Chike's Oils Limited cash flow and operating activity using the indirect method in accordance with IS 7. Statement of cash flow for 5 months, total 20 marks. Thank you.
Thank you very much, Shidera. Okay, so let's try and solve this together using what we have learned so far. So let's look closely at the requirements again. The examiner says that calculates the following ratios for the year 2022 and 2023: gross profit percentage, net profit percentage, gearing ratio, and for 9 marks. So apparently, each ratio is 3 marks each. So, and since you are calculating each ratio for 2 years, that should be 1.5 for each year, 1.5 marks for each year. Okay, that's reasonable. And we are asked to comment on relevant qualitative factors that may impact on the company's performance. I like this. This is the importance of solving past questions. It gives you further perspectives into other areas the examiner could look at. And if you remember, we did not mention qualitative factors during our analysis. We only focused on the ratios, but the reality is that there are a lot of non-financial factors, which is qualitative, that can really affect a company's performance. I mean, and the very obvious one would be the quality of their leadership, the management quality and the caliber of their leadership, or their regulatory environment. If they're in a country where there is high inflationary trends, if they're in a country where there is insecurity, it becomes a problem. Another one is the business model of the company, business model, right? So some companies are successful because they got their business model right. Look at companies like Facebook, for example. They got their model right. So people use their platform for free. You can go on and use Facebook for free. But they found a way of making money from you. I mean, when Facebook was going to acquire Instagram some years ago, Instagram was not making any money. But look at Instagram now is making billions of dollars. They got the business model right. So business model can affect performance. Another one is the quality or the quality or how the organization treats their employees also can also affect the performance of that company, because if you don't treat your employee right, they will not give their best. And it could also be political instability in the country. And it could also be tone at the top, corporate governance structure. It's plenty like that you can really actually come up with in the exam. So we'll get there. But so this one, let's quickly solve this ratio. This will be a bonus mark for most of you, but let's really apply what we have learned. So majorly, we are looking at GK Oils Limited, which is an oil and gas company operating in Nigeria. And the management of the company presented the account for 2 years. So they give us 2 years account. That's 2022 and 2023. And they did the same thing for statement of financial position as well, 2 years. And they give us an additional information. So majorly, this additional information is telling us that this company will want to analyze a Chike that they bought controlling interest, 60% interest in the equity shares of Dukalago, a commercial cocoa production company, in order to diversify its business portfolio and take advantage of favorable incentives in agriculture recently announced by the federal government. So now we're now told that this company they acquired has increased its percentage, is plantation acreage based on average yield per hectare. That means the company is doing well. And we have not really received any dividend from Ducal, and the value of its shares are not increased. So majorly, I mean, the company is not profitable yet. That's what it is. That's why you can't pay dividend. I mean, probably they are investing or there's something happening in the environment. We don't have sufficient information yet to really speak to what is happening. But let's quickly calculate the ratios here. And what are the ratios we're looking at? So the first ratio here is gross profit percentage. So can somebody remind us the formula for calculating gross profit percentage? Can somebody remind us quickly?
Gross profit all over sales times 100.
Thank you very much. Gross profit all upon sales times 100 over 1. That's our gross profit percentage. So we are calculating for 2 years. That is 2023 and 2022. Let me put, I think it was in millions. The level of rounding off is in millions. Yes, it was. Yeah, it's in millions, 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 millions. So let's get the gross profits for 2023 and 2022 from the P&L. So in 2023 is 1093, in 2022 is 982. So we have 1093 and we have one, am I correct? 182, 982, 982. And our sales, what was our sales in 2023 and 2022? 3645 2457. 3645 and 2457. So divided. So can you please give me the formula? What's the answer?
For 2023,
Okay.
29.98.
29.98. Let's do 30%. How about 2022?
40%.
40%. Okay. And just multiply by 100 to avoid unnecessary complaints. Okay. Number 2, they asked to compute net profit before interest and tax percentage. Net profit before interest and tax percentage. So what's the formula for that?
Profit before interest and tax over sales.
That's correct. Profit before interest and tax over sales. That's my PBIT all upon sales. So for the 2 years, my PBIT in 2023 and 2022. So what's my PBIT from here?
261.
261.
No.
Okay.
Look at it very well.
For 2023,
Mm-hmm.
it is 315.
How did you get?
If we deduct the finance cost. No, 626.
How did you get your 315?
I deducted finance cost.
From what?
No, like the profit after the deduction of administrative cost and distribution cost.
Yes. So you should just add, since the PBT is 261, right? And you're looking for the profit before the deducted finance cost. All you just need to do is just to add back the finance cost. So it's just 261 plus 54. Just 261 plus 54. So for this one, for 2023, 261 plus 54, that will give me my answer for 2023. And for 2022 is 527 plus 9. The 527 plus 9. So you find in your exams, they usually test you on this quite a number of times. And a lot of students usually fall trap of this. So 264 plus 261 plus 54 is 315. 527 plus 9, that's 536, right?
Yes, sir.
All our sales, 3645, 2457. So what's my PBIT percentage
8.6.
for 2023, I guess?
Yes, sir.
Okay. What about the second?
21.8.
21. You can leave it in one decimal place. 21.8. Number 3, gearing ratio. Gearing ratio. So what's the formula for gearing ratio?
Long-term debt all over long-term debt plus equity times 100.
That's correct. Long-term debts. All of them. Long-term debts plus equity times 100 over 1. So what's our long-term debt here?
For 2023.
Okay. How much?
510.
Okay, 510. What about for 2022?
120.
120. What about my equity?
2023.
Let's do equity plus debt, plus that long-term debt. Yeah. Mhm. So let's do 510 plus equity. In 2023, what's our equity? That's 1095.
1095.
Okay, 1095. And this one is 120 plus, what's the equity here?
743.
743.
743. Okay, so let's get our ratio. So my gearing ratio, Alani, I can see your hand. Please ask your question.
Hello, good afternoon, sir.
Good afternoon.
Sorry, sir. I don't know if I can have this, what's it called, this note, because I'm just a new member to the class. This is my first time of attending this.
Oh, yeah. As we usually send it after the class. So because as you can see, I'm just creating for this particular class, but for the previous classes, I will share it along with this after the class. But you can actually have access to this correction on ICAN website. That's where I got it from. If you want to be following the correction
Okay,
along, yeah.
okay, note.
Okay. Okay. So what's the gearing ratio here?
For 2023.
How much?
31.7%.
That's 1.7%. What about for 2022?
13.9%.
13.9. Can't hear
Yes,
you.
sir. 13.9, sir.
Okay, good. So we have gotten 9 marks. Now, the second one, we are asked to comment on relevant qualitative factors that may impact the company's performance. So now, from here, is there any qualitative factors that is non-financial that can impact on this company? So the only thing I can pick from what is happening here, if I want to direct my qualitative factors on what happened to this company is the fact that they acquired this other company that is in the agricultural sector. And as you can see, even though the company, Dukalago, has increased their plantation outputs based on average yield per hectare, but yet they have not been able to receive dividend from them, and the value of the shares of the company is not even increasing. So, is there anything around that could affect this company that we could come up as a qualitative factor before we move on to other general ones? So, qualitative factors. This is solution 2. qualitative factors that can impact the performance that can impact on the company's performance. Number one, what's the first one? We can say how can we put this one that would not be non-financial? This acquisition they made in this other company in a way that will be non-financial. Okay, we can put it as if your investment is not performing. Okay, let me start with their own general issues then. So we can look at the management or the leadership quality of the company, the leadership quality of the entity, right? So if a company has experienced leadership with a track record of success, it will impact the performance of the company. Number two, corporate governance. Corporate governance. So, corporate governance. So, a company that has a good corporate governance structure, will not be susceptible to fraud and mismanagement. So it will impact their performance. Another one is the political instability. So if the political environment is stable, it will impact performance of the company. Number three is macroeconomic environment. So if the macroeconomic variables like inflation, interest rates, and exchange rates are stable in the country, it will impact on the performance. It will impact on the performance of the company. Another one is corporate culture. Corporate culture and work ethics. The company. This can also impact performance. So depending on the work ethics and the entities culture. Another one is employee motivation. So a company whose employees are highly motivated would have good performance. That would also affect the performance of the company. How many marks? 6 marks. So company whose employees are highly motivated this will greatly impact on its performance. And many more that you can actually think of that are qualitative. It could either be the business model of the company. It could be the quality of their products. Could be the location of the company. Location can affect performance too, right? If you are located in a place where nobody will see you, it will affect your performance. Okay? Can anybody just lend a voice? Is there anyone that you think you want on this list that I didn't put here? There are plenty of them.
So how about advertisements? That's to advertise the product more.
That's absolutely correct. Marketing and publicity. Marketing, publicity. This can also affect the performance of a company. Okay, so we're able to come up with 10 points. That's good. Now, the C talks about that we should prepare Chike's Oil's limited cash flows from operating activities. Okay, so we haven't done cash flow statement, so let me not even go into this. Most likely, I'll teach you cash flows next, immediately after I'm done with sustainability reporting. I would treat cash flows. So I know that what I have left is just group account and accounting standards, so which will face squarely. Okay, so that's all for that diet, November 2025. Now let's go to May 2025. Okay. Or do you have any question for this last diet question? No question. It was actually very easy. Okay, let's go. Chidera.
Okay. The following are the financial statement of Orak Venture Nigeria Limited for the years ended December 31st, 2023 and 2024. Statement of profit or loss for the year ended December 31st for 2024 and 2023. All figures raised in millions assumed to be correct. Statement of financial position as at December 31st, 2024 and 2023. All figures raised in million assumed to be correct. Additional information. Additional information, sir.
Okay.
Okay. The directors of Orak Venture Nigeria Limited appointed a new sales manager during the year ended 2024. The manager introduced a new sales policy to increase sales and profit by means of reduction in selling price and extended credit terms to the company's customers. This led to the considerable investment in new plants and equipment early in the year 2024 to meet the increased sales required. Calculate the following profitability and liquidity ratio for years 2023 and 2024. Profitability ratios. We have gross profit margin, net profit margin, return on capital employed, where capital employed is equal to equity and borrowing. Liquidity ratio, we have current ratio, asset test ratio, receivable collection period in days for 6 months. Thank
You
you.
know that you can see that they are not consistent. They are not consistent. So in last diets, you asked 3 ratios for 2 years. You give them 9 marks. Almost similar ratio, 9 marks. These diets, the diet before, you give them 6 ratios. 6 for 2 years. You now reduce the mark. Where is the consistency? Is it that they had an information that or what? Okay, read the B part.
The B part says, explain whether the financial performance and position of the company has improved for the year ended December 31st, 2024 as a result of the new policies adopted by the company. C. Calculate the amount of cash which would be realized if the company would impose a debt correction period for 45 days. Note, all revenue are on credit.
Okay, so apparently, so that's the way the exam is. Some diets, they are lucky, depending on the mood of the guy that is setting the question. Some diets, they are not. Apparently, this May 2025 is a much more advanced question than the November. So those other guys were lucky because that one was very straightforward. The guy was just dashing game marks like that. So since you're used to this, so we are asked to calculate profitability and liquidity ratios for 2 years as well. And they give us some information. What's the name of the company in question? ODOT, okay? Dot Ventures. They give us their P&L and estimate of financial position. So the major thing that happened is that this company appointed a new sales manager. And this new sales manager introduced a new sales policy to increase sales and profits. And what he intends to do is to reduce their selling price and extend credit terms to the company's customers. And extended, meaning that they are going to give them more days to pay, more days. So this led to considerable investment in new plants and equipment early in year 2024 to meet the increased sales. So they invested a lot of money to meet the increased sales. Okay. So let's do the computation. Again, you can see that this diet now, they call this gross profit margin. In the other diets, they called it gross profit percentage. So whatever they call it, good to go. So let's compute it. We'll have gross profits all upon sales multiplied by 100. Again for 2 years, 2023 and 2024. So the earlier years comes first, in 2023. And I will put the level of rounding of millions, because that's how they gave us the question. So my gross profit, let me move it back a little bit. My gross profit, let me go to my P&L. For 2024 is 17,920. For 2023, 8,640. So 17,920. 8,640. My sales in
48,
2024,
44, 800.
44,800. In 2023,
14, 400.
14,400. Okay, 14,400. Then let me multiply it by 100. So my gross profit percentage or margin in 2024 is how much?
40%.
40%. And 2023,
60%.
60%.
60%. Okay. So the next ratio is net profit margin. Now, again, you will see that in that May 2025 diet, Abi, November 2025 diet, the guy was so nice that the net profit margin he asked them to calculate, he told them the profit they should use. He didn't confuse anybody. He told them net profit before interest and tax. He told them specifically. But this one again, he did not tell anybody. So usually, if we have that kind of scenario, use your net profit as profit for the year or profit after tax. Okay? That's what you use as net profits. If the guy did not tell you the nature of the net profit. So net profit is the last profit. Profit for the year or profit after tax. So all upon sales times 100 over 1. So what's my profit after tax for 2024? What's my profit after tax for 2024? Funny enough, they didn't give us, we don't have profit after tax. No sweat, no. So we know that net profit will be the last profit. So since they stopped at net profit before tax, so let's use that, right? So 4,960, 4,832. 4,960, 4,832. So let me just change the name then, if that's the case. All upon my revenue. or my sales, which is 44,800, and this is 14,400 multiplied by 100 multiplied by 100. So what's my net profit margin?
11%.
11%. How about in 2023?
34%.
34,
Okay.
34%. Number 3, we're asked to calculate return on capital employed, where capital employed is equal to equity and borrowings. So return on capital employed. I think I taught you something around this. That where the examiner specify what you use as capital employed, that you should be careful which profit you use. So in this case, where the examiner told us that we should use our capital employed as equity plus borrowings, right? Equity plus borrowings. So what would be our profit? Do you remember?
Profit before interest, tax, and tax.
That's correct. Let me look on. That's it will be your PBIT. That's correct. Profit before interest and tax. I have so much space. Profits before interest and tax. So if you go and use any other profits, then you will not be matching with this. The guy is actually waiting for you to make that mistake. So please don't fall in his trap. Make sure you use PBIT as your profits if they give you capital employed. So what's our PBIT in this case? You can tell me.
We will add the interest expense back to the net profit before tax.
Absolutely correct. Absolutely correct. So there is similar to the November 2025 diet. Okay? It's similar to that. So that means it's something you find often. So get used to it and don't make mistakes with that. So that means in 2024, our PBIT is 4960 plus 30772. Our PBIT is 4960 plus 3072. And in 2023 is 4832 plus 192. 4832 plus 192. Okay, so how much is that? Well, let me get the first one, then the second one.
8032.
8032. How about the second?
5024.
5024.
5024. Okay. Then my equity plus borrowings. So let's go and check First, my equity for 2024 is 2272. If you can all see it, 2272. And my borrowings, which is directly below it, is 25,600. Okay, so 2272, 25,600 times 100. Whereas in 2023 is 14,864 plus 1,600. 14,864 plus 1,600. Okay, so what's my ROC? ROC is return on capital employed. So what do we have?
For
17.
2024,
Mm-hmm.
17.5%.
In 2023,
It's 17.35. If you approximate, that should be 17.4.
okay, okay. How about 2023?
%31.
Sorry?
31%.
Thank you, Balkis. 31%. Number 4, we are asked to compute current ratio. And how do you compute current ratio? You all know that it's current assets all upon current liabilities. What's my current asset in 2024? Okay, I've seen it up here. 13,136. 13,136 and 2023 is 2,000. My current liabilities, 2024 is 2,976, and this is 576 for 2023. 2,976, 576. So what's my current ratio?
Uh,
4.4.
5 points.
4,
4.
4.4.
Okay. Is this how you are going to write the answer, or how am I going to write the answer?
4.4 ratio 1.
4 times.
Not
4.4.
ratio 1. Okay.
Yes.
Not 4.4 times. So how about this?
3.5 is to
Okay. Then we are asked to determine acid test ratio. An acid test ratio is your current assets minus your what?
Inventory.
Inventory All upon your what?
Current liabilities.
Current liabilities. Up there, we have already established our current assets to be 13,136. So we need to get inventory for the 2 years. So inventory in 2024 is 3808, and in 2023 is 480. So 3808. Current liabilities up there. This is 480. All upon my current liabilities for this year is 2976, while this one is 576. So what's my current ratio?
First one, 3.1:1.
3.1:1. It's not current ratio, asset test ratio. And the second year?
2.6:1.
6:1. Okay. Finally, we are asked to compute receivables collection period. Receivables collection period. Can you remind me what's the formula for that without dubbing? Can you remind us?
Trade receivables over credit
Trade
sales.
receivables all over sales times 365 days.
Actually, credit sales. In this case, what's our trade receivables? What's our credit sales? In 2024, this is 9328, 2023, 1328. Okay. 9328, 1328. They're so similar. And I think we have our sales up here. 44,800 and 14,400. Don't forget, you have to multiply by 365. So how many days are we looking at?
76 days.
Okay. How about the second year?
Thirty-four days.
34 days.
Okay, that's for this. Okay. That's all. So I can't still believe that they asked us to do 6 ratios for 2 years just for 6 marks. It's okay. Please, we are done with it now. The B parts, we are asked to explain whether the financial performance and position of the company has improved for the year ended 2024 as a result of the new policies. Now they are giving us 7 marks for this. Just give me 1 minute so I can farabalẹ̀ and do this one. I am back. So now let's learn how to analyze. So you'll see that the examiner really asks you to explain whether the financial performance and the financial position of the company has improved for the year ended 31st December 2024 as a result of the new policy. So now, I want to talk about financial performance and position, financial performance and position of, I think, ODOT, something like that, ODOT Ventures Nigeria Limited. Let me confirm. ODOT Ventures Nigeria Limited, correct. So now, if they're asking me whether it has improved for 2024, if they're asking me whether I should explain whether it has improved, I know that what they want me to do is talk about the ratios. That's really what they want me to do. And if I'm talking about ratios on financial performance, then that will be profitability ratios that we need to talk about. If I'm talking about ratios on position, that would basically be liquidity ratios. So they really want me to speak to the 6 ratios that I've computed above. And before I jump into writing anything, I just want to scan through the ratios I've computed just for me to have an idea of the direction of these ratios so I can know what I'm speaking to. And again, before I want to do that, the question wants me to explain the performance and position vis-a-vis the new policies adopted by the company. Now, what's the new policy adopted by the company? Is a policy that, if you look at this additional information, they said they got a new sales manager, and this manager introduced a new sales policy to increase sales and profits by means of reducing selling price and extended credit terms to customers. So the guy came and reduced selling price, and he also extended credit terms, meaning he was giving people more periods to settle their receivables. So let's see if it worked, right? So if you look at the gross profits margin in 2023, it was 60%. Now it is down to 40%. It didn't improve, it got worse. Net profit margin was 34%. Now it is 11%. It didn't improve, it got worse. Return on capital employed was 31%. Now it's 17.4%. It did not improve, it got worse. Our current ratio was 3.5:1. Now it is 4.4:1. That improved. Our asset test ratio was 2.6:1. Now it is 3.1:1. That improved. Our receivable collection period was 34 days, and this, of course, so this was really the policy they implemented. So, they extended credit time. So they were doing 34 days before, but now it is on 6 days. So I cannot really speak to this because that was what they did. So now, how do I explain this? So I can say you can write it in whatever way, but this I want to start with the context first. Following the introduction of the new policy, the new sales policy, which introduced a reduction in selling price and extended credit terms. So following the introduction, the financial performance and position of other ventures was impacted in the following direction. The gross profit margin declined from 60% in 2023 to 40% in 2024. Full stop. This shows that the reduction in selling prices resulted in a depressed gross profit. This is because the reduction in prices and selling prices was not matched with reduction in purchase prices. So they didn't remember to get discount from their own supplier. They were giving discount to their own customer just to increase sales. So they reduced their sales. Of course, it's expected that gross profit margin will be impacted if you don't find a way to reduce your costs. So which is what I've explained here, that the profit margin declined. Yes, full stop. And I showed them what I is showing. Shows that reduction in selling price that they did, it depressed their gross profit margin. And no, I made a mistake. And this and I wanted to say, and this is because I wrote something else. And this is because, yeah. So that's that one. The second one is the net profit margin. So net profit margin declined from 34% to 11%. Yeah, 34% to 11%. To 11% in 2024. So what is this showing? So this shows that that the company's policy to reduce selling prices has greatly impacted on net profits and this is because the overheads were increasing. Let me see, let me do a trend analysis. If you look at their selling expenses, it went up. If you look at their bad debt written off, it went up. If you look at their depreciation, it went up majorly, and even their interest, it went up. So majorly, those were the impacts, those really impacted. And this is because the overheads from year on year significantly increase, and particularly the bad debts resulting from the extended credit term. So that really affected their net profits, depressing their margin, declined it. And finally is the return on capital employed. Return on capital employed. I'm sure it also declined. Now from what to what? From 31 to 17. That's almost 100% in 2024. So this shows that the return available for investors has been depressed as well. So the above shows that the above analysis shows that the financial performance of the company has declined. Then the current ratio improved from 3.5 to 4.4. So 4.4 ratio 1. This shows that the company has more liquid funds to settle highly short-term obligations. The current ratio and quick ratio or asset ratio. Let me put them together. And I can put them together. And which one is what's the asset test? I can put them 2.6 to 3.1. So 0.6 ratio 1 to 3.1 ratio 1 respectively. The above shows that the financial position of the company has improved from liquidity perspective. From liquidity perspective. Okay, so this is how we're going to go about it. in the exam, this is a very exam-friendly analysis to a very large extent. So the easiest way for you in the exam that I can think of is for you to pick the ratios you have computed one by one and speak to them as much as possible without wasting too much time. So majorly what we are looking for is for you to know whether an increase or decreased ratio means there is a decline or an improvement in performance, which we try to mention here. And we also try to note what a decline shows and what an improvement shows as well. So that is what I've demonstrated to you here. So I saw that the gross profit margin decreased. I told them it declined. And I told them what it shows. Okay, because they reduced selling price. That's okay. That was what depressed the gross profit margin. And that's because they didn't match the reduction with claiming reduction in purchase price. I used the same format for every other ratio. And after I completed my profitability ratio, I told them that, okay, since they asked me to explain financial performance, I told them generally their financial performance has declined following from the above analysis. And I did quick ratio and current ratio, put them together because they measure the same thing. Then I use that to say, okay, their position has improved from liquidity perspective, right? From liquidity perspective as it is, from what we can see. And that's the solution for that. So this is how you carry out analysis by putting the context into perspective. Okay. Now, the last part of this question asks us to calculate the amount of cash which would be realized if the company would impose a debt collection period of 45 days. The amount of cash which would be realized if the company could impose a debt collection period of 45 days. And they gave us seven marks. What can we do here, guys? How do we approach this? Is there anyone that can help us? How do we approach this one? So calculate the amount of cash which would be realized if the company could impose debt collection period of 45 days. So as it is, based on our computation here, the debt collection period right now is 76 days. Based on what we computed, that's the debt collection period. So we are saying that if the debt collection period is 45 days, meaning if we can collect our money earlier, how much more money are we going to have? Right? So which is a rational question in the sense that, so since we are doing 76 days now, we are having receivables of 9328. They are saying that if we can do 45 days, we believe that our receivables will reduce. You see, that reduction in receivables is the answer you are looking for. Because reduction in receivables mean more cash for you. It means more cash by the time your receivables is decreased. So we are going to assume the receivables as the unknown figure, while we know the answer as 45 days. So the C is in such that trade receivables collection period is equals 45 days, in the sense that our trade receivables all upon credit sales multiplied by 365 days equals 45 days. So what we are looking for should now be the trade receivables. The credit sales remains the same, which is 44,800. So if I multiply by 365 days equals 45 days. So how do we get my trade receivables? So first, let me represent these trade receivables as TR. Okay, so TR times 365. So let me say 365 TR. Okay, divided by 44,800 equals 45 days. So I can divide both sides. I can cross multiply, if you know what I mean, in the sense that I'll have 365 TR equals 45 multiplied by 44,800. So 365 TR equals, what's 45 times 44,800?
1,16,000.
So if I divide 2 by 365, so TL becomes 2016 divided by 365. What would that give us?
5 million. No. 5,523.
5,523.
Yes,
So
sir.
here's my trade receivables. So what's my trade receivables at 76 days? When we're doing 76 days. So it's 9328, Abi?
Yes, sir.
So what's the reduction in trade receivables?
Okay.
Which is the same thing as the cash, the additional cash available that we're going to have.
3,805.
3,805,
805.
which is this minus this. And this is the answer. So the guys that did, not that the thing is difficult like that, but it wasn't as easy as last diets. So those guys that did May 2025, they will sweat. They will sweat. They'll be sweating in the hall, especially the ones that are not so good with. But nobody's going to teach you this one, except if you have seen a question like that before. From that, is really good solving past questions, because there might have been a question like that before. In fact, there has been before, anyways. So you might have used that to learn. There was a guy they asked something like this as well. It's really good solving past questions. So that will have helped you practice something like this. Otherwise, there is no way you will have been able to attempt this particular one. And it's 7 marks. Calculate the amount of cash which would be realized if the company could impose a debt collection period of 45 days. Like that. So it's just for you to compare, okay, what would the receivables be by using this approach? And what was my receivables when I did 76 days? So decreased like this. So this is additional cash. This is the amount of cash that would be available. Let's solve one more question, then we'll continue in the evening when we come for our second period. So we are done with May 2025. Now let's go to 2024, November 2024. Shidera, are you still there?
Sir.
Yes, I'm here.
Okay.
Hello, sir.
Yeah, Lekon wants to ask a question. Go ahead, please.
Sir, I want to ask a question, sir.
Yes, please ask.
Sir, in the case of where it's not even about the question we just solved, but in a scenario where two different companies, but in the same industry, whenever they show similar profits, but different financial positions, sir. So what would someone prioritize when explaining the difference? Like, what could be the difference?
So you see, the best way is just to speak to what you can see. Speak to what you can see. So if one is having a better performance, speak to this guy is having a good performance, this and that. If this guy is having a good position, speak to that. But if they are not asking you which company should they buy, I don't think they ask you at this level. So they don't ask you at this level. But if I just want to ask a question, answer a question as out of curiosity. So usually position is really a thing to prioritize, position, because position can impact going concern. If a company is not liquid or a company is not solvent, so solvency measures stability. If a company has a lot of long-term debt and its gearing ratio are so very bad and is declining, it keeps increasing to beyond manageable level, it's difficult to advise. You would prioritize position over, because a company that is not profitable but is liquid and its position looks good, it's just a matter of time. It will get better. Maybe it's just spending a lot of money on marketing or spending a lot of money on R&D just to improve over time. But its position is fine. So position is something you prioritize over performance. So I'm just asking you a question out of curiosity, but ICAN does not really go there for you for skills level. As you can
No,
see.
I'm not even asking it on our class. It was a scenario that happened, so that's why I'm asking the question, sir.
Okay. Okay, so you really prioritize position.
Thank you, sir.
Yeah. Okay. Let's solve one more question before we go. Yeah, Shidera.
Okay. November 2024. Orak Nigeria Limited is a specialist computer component manufacturer. The company presently has a staff strength of 54 employees and it has two main customers located in the southwestern part of the country. However, the relative success of Orak Nigeria Limited over the last few years has attracted interest from a number of potential buyers that want to acquire the company. One of the Orak Nigeria Limited main customers, Datamatic PLC, is now considering making a bid for the entire share capital of Orak Nigeria Limited, thereby effectively bringing Orak services in-house. Datamatic PLC is of the opinion that the specialist products that Orak Nigeria Limited supplies, it will now be under their company's control. The financial advisor of Datamatic PLC has obtained the following information relating to Orak Nigeria Limited. Extract from the financial statement of Orak Nigeria Limited for the year ended September 30, 2023. All figures raised in thousands, assumed to be correct. Information obtained from Computer Component Manufacturers Association industry data. Average PE ratio for quoted companies. Should I go ahead and read this or?
Read it, please.
Okay. Average P/E ratio for quoted companies is 9%. Average annual growth in the reported post-tax profit from 2022 to 2023 is 3%. Average pre-tax profit margin 5.1%. Average pre-tax ROCE is 13%. Average receivable collection days is 78. Average payable payment days is 34. Average revenue per employee is 2,313,000 naira. The finance director of Datamatic PLC has provided the following summary of the Datamatic PLC recent performance as at September 30th. We have 2023 figures, 2022, 2021, and 2020. All figures are assumed to be correct. Required. Compute the following ratio for Orak Nigeria Limited. 1. Gross profit to capital employed. 2. Pre-tax profit to capital employed. 3. Gross profit margin. 4. Net profit margin. 5. Non-current asset turnover. 5. Receivable collection period in days. 6. Payable payment period in days. 7. Inventory turnover in days. 8. Revenue per employee. 9. Dividend cover. 10. Current ratio and quick ratio for 12 marks. Then the B part of it says, analyze the financial position and performance of Orak Nigeria Limited for the year ended September 30, 2023, and determine if the Datamatic PLC investment in Orak Nigeria Limited will be worthwhile. 8%.
8 marks, 20 marks. Okay. So how many years are we computing for? Okay, just 1 year. So this is better than the diet before. That May 2025, the guy wasn't joking with them at all. So this is better. They're supposed to do one ratio for 1 year, but this is just 1 year account that we were given. They give us just 1 year account. So, and they ask them to calculate 12 ratios. That means 1 mark per ratio, which is fair. Then they will analyze performance and position based on what is computed, 8 marks. So we'll just find a way to work around the analysis, just so that we are not the ones that are measuring the same thing. We'll group them together, then we talk around some factors that resulted in their decline, just so that we have actually spoken about performance and position as it were. and we'll determine if the mathematics investment will be worthwhile based on what we have actually, based on our analysis. So let's compute that. So the first ratio here for this A parts again is gross profit margin. And always put your formulas in the exam. It's very important. Gross profit margin is equal to gross profits all upon what? All upon sales multiplied by 100.
There are two. The first one is gross profit to capital employed.
Thank you, Matthew. Gross profits to capital employed. So what's the formula for that? Hello, class. What's the formula for gross profit to capital employed? Can I even try?
I guess it should be gross profit over equity.
Yeah, I mean you have tried. So, but it's just better we use equity plus borrowings or plus the long-term debts. Because since I mentioned that if you are using PBIT, if the examiner tells you that capital employed is equity plus debt, that means your profit should be PBIT. So now that your profit is even gross profit, so you have to use the two. So don't just use equity. So what's my gross profit from the question? What's my gross profit? Anybody? What's our gross profit? They didn't give us, so let's calculate it. That will be revenue minus cost of sales. What would that give us?
95,130.
95,130.
95,130.
Okay, I hope you remember how we got it, or you want me to write it in bracket? So 2950, 125,820. Okay. So let's do equity plus debt. I mean, looking at the information they gave us, I can see we don't even have debt here. They didn't give us anything around borrowing, so we can just use equity. So what's the figure for equity here? How do we get equity here?
86,400.
No, that's not equity. That's retained earnings. How do you get equity?
9,000 ordinary shares.
Retained earnings plus ordinary share capital.
Thank you. Sure. So that's how you get equity. Ordinary share capital plus retained earnings. I've taught you this before. Please need to be revising. So I think that's 9,000 plus what? It's 6,400. 6,400. So what does that give us?
95,400.
Okay, so divide times 100. So what's my gross profit on capital employed? What's the answer?
98%.
38%. So what's the next one? I have pre-tax profit to capital employed. Pre-tax profits.
It's 98%, sorry.
Oh, okay. 98%. Okay, thank you.
And sorry, sir, if you can calculate it, the gross profit to capital employed, it should be 99.7%, sir.
Okay. Okay, let me check it.
It's correct, sir. 99.7.
99.7. Okay, good. Okay, good. So the second one is pre-tax profits to capital employed. So can you guess the formula for this?
Profit before
That would
tax.
be okay, profit before tax. All upon what? Now I know
Capital
that
employed.
Equity.
yeah, that's correct. So now I know that my capital employed is equity because they didn't give me debt. If they had given me debt, I will have used equity plus debt. So I was given profit before tax as 17,100 from the question. Profit before tax as 17,100. And I already know what my equity is. That is up here 95,400. So times 100. So what's my pre-tax profit to capital employed? What do you have?
18%.
10%. Wow, what a decline. Can you imagine? Gross profit to capital employed was 99.7. This one came down to. Anyway, let's leave that. When we are analyzing, we'll talk about that. So the third one is now gross profit margin. Which is my gross profits all upon what? All upon sales multiplied by 100. So from up there, I know that my gross profit is 95,130. But I don't know what my sales is. So what's my sales? 229.50. 229.50 times 100.
3%.
Sorry?
43%.
43%. Okay. And we are asked for net profit margin, which is my net. What should I use as my net profit? Let me see what they gave me. Okay, I will use profit for the year. So it's the final profit, which is 11,970. Profit for the year all upon sales. I said, I think 7970. What did I say again? Let me confirm. 11,970. 11,970 divided by sales. What's my sales? 220,950 times 100. What does that give us?
5.14.
5.14.
5.4.
It's 5.4.
Okay, thank you. Number 5, we are asked to calculate non-current asset turnover. Who can tell me the formula of this? Non-current asset turnover. Can anyone attempt?
Non-current asset over sales.
Non-current asset over sales.
Sales over non-current asset.
Yes, it's sales over non-current assets. So it's the one that has anyone that you see can you turnover is that item that will be the denominator. So it's actually sales over non-current assets, which is the number of times an entity is able to convert his non-current assets to sales, right? So in this case, our sales is 220,950. What's our non-current assets? 8460. 8460. So that's how many times?
2.7 times.
2.7 times. That's 2.7 times. So 6. We asked to compute receivables collection period in days. Receivables collection period in days, which is trade receivables all upon credit sales times 365 days. So what's our trade receivables? Yeah, from here, 13,140. 13,140. Credit sales is, except otherwise stated, it's the same thing as the sales that you have times 365 days. That's how many days?
22 days, sir.
22 days.
22 days. Number 7, payables payment period. Payables payment period in days. That will be my trade payables all upon your credit purchases of cost of sales. That one, depending on what is given. Multiply by 365 days. So, what is my payables? I was given my payables as 21,960. And my cost of sales 125,820. So let me 21,960 all upon 125,820 times 365 days. So how much is that?
51 days.
51.
61. 61.
Okay, 61. 8 inventory turnover days. Which is my closing inventory all upon my what? The cost of sales times 365 days.
This 61 should be 64 days, sir.
Oh, okay. Thank you. 64 days. Can one more person confirm?
Yes, correct.
It's correct, sir.
64 days, sir. 64 days.
Okay, great. So what's our closing inventory from here? Okay, they give us inventories 2880. 2880 all upon my cost of sales, which is 125,820 times 365 days. So how much is that?
That's 61 days.
61 days. Then 9. Revenue per employee. Who can try the formula for this one? Revenue per employee. Who can try the formula for this? Because I'm not sure I mentioned it.
Let me try.
Okay.
Go ahead,
That
please.
is a total revenue over number of employees.
That's correct. That's very correct. That's my sales over number of employees. So sales per employee. So what's our sales? We already know our sales for as 22,950. What's the number of employees that this company has? I think they gave us somewhere. The first paragraph. They said they have 54 employees. They have 54 employees. So how much is that?
$4,092.
Okay, so we forgot to put, so that we not think these figures are actually the way they are, because they give us in thousands. So it is actually 4,092,000. So number 10, dividend cover. Dividend cover Do you remember the formula for dividend cover? EPS?
EPS divided by dividend per share.
Correct. I'm not sure they give us like that. They didn't give us EPS, but they gave me the profits for the year, which is 11,970 over dividend paid, 5,850. Level 970 all upon 5,850. So it's usually times. Even this one, okay, I put times there. So how many times?
2 times.
Exactly 2 times. Not 2 point something.
2.046.
Okay. So 11 give us current ratio. Current ratio, which is current assets all upon current liabilities. So what's my current assets? Okay. Yeah, they didn't give me current asset directly, but they gave me inventories 2880. They gave me receivables 13140. They gave me cash and cash equivalents 2880. So I can use that. Okay. 2880. Plus, people were not cramming it. Let me go back. 2880, 3140. 3140 and 2880. What's my current liabilities? It's only payables, 21,960. That's the only current liabilities item we have here. Payables, 21,960. So just give me the final answer.
1.7.
1.7. Ratio what? 1.7 to 1. I think the last one is quick ratio, which is current assets and as inventory.
Sorry, I didn't get 1.7. No, what I'm getting is 2.5 is to 1.
Okay. Let one more person confirm.
0.7.
1.7 is correct.
Huh?
1.7 is correct.
Please let's confirm.
It's 1.7, sir.
Okay, good.
1.7 is correct, sir.
Okay, good.
1.7.
Good. All right. So, my current assets, they didn't give us, but I know that which of these is inventory again? Is it so just 13,140 plus 2880 is what I'm looking for. Since I'm taking out inventory. all of them. So what's my ratio? What's my ratio?
1.1.
Having 0.73.
0.73.
0.73 ratio 1. Okay. So when we come back from our second period, we are going to do this B part. So when we come back, we are solving more ratios like that. And there was this one I'm keeping, which it will be the last question I'll solve when we come for our second period. This one, there was this diet, November 2020. They have not repeated it, but I keep solving it for my students every diet in case they decide to repeat it, because I actually discussed it with you. So just want to show you how to solve it. So when we come, we'll finish this November 2024. We'll solve May 2024, November 2023, May 2023, and that other one. Then just solve as many as you can. As many as you can, just so that you are used to it. This is something that comes out every diet, and you can see every diet with its own peculiarity. So if you can solve like 6 diets together, I think that's enough for you to then go ahead and practice much more like that. Okay, so I'll see you guys later. Bye.